Even in an AI-focused world, MacroEdge is in the business of focusing on you. We don't just understand our clients, we listen to what's said and illuminate on what's not. In a world moving at the speed of light, with shifting markets, evolving workforces, and non-stop disruption, MacroEdge helps you to navigate and identify novel opportunities, expand your enterprise, and succeed in tomorrow's world. And it all starts with you. Put your enterprise and your perspective in the driver's seat. We're in the business of you.
Good evening, everyone. Welcome to MacroEdge Radio. This is John Galt speaking. It's Friday, September 26, 2025. And of course, if we're talking macro, it's MacroEdge. Boys and girls, we have a very special guest with us tonight. I'm going to do a quick market summary just to give you an idea of where we're at, because there's a lot of moving parts. Let the rest of the audience catch up to us and join us. One of the bigger things that we've seen is it's month end, it's quarter end, and it's crazy time end. Things are not as they seem. And I think some of the technical analysis we'll hear tonight and some of the opinions will sit there and provide more in-depth ideas for those of us that follow our team. Real quick, as everyone filters into the room, the Dow was up 299 to finish at 46,247. S&P 500 up 38 to 6643. NASDAQ up 99 to 22,484. Gold at another all-time high, up 37.90 to 38.09. Silver up $1.54 to 46.65. Impressive move in silver. Stay tuned. We've got a little room to run. Platinum up 52 to 15.82 as platinum begins to join the party in a very full-throated manner. And look who's back. WTI crude up 74 cents to 65.72. Brent up 25 cents to 69.67. Dollar yen 149.52, as I wrote about yesterday. This is something that bears watching. I think the Bank of Japan proverbially screwed the pooch, missed their opportunity, and may have invited the carry trade back to the party. We shall find out soon enough. 2-year finished the week at 364, the 10-year at 417, 10s, 3s at 0.21, 2s, 10s at 0.53, and without further ado, let's welcome Michael Kramer. On X, he's known as @Michael, MOTTCOM. Substack has his own Substack. And if you have not, I discovered him on Seeking Alpha long before X. I suggest everyone follow his articles on Seeking Alpha. Michael, welcome to MacroEdge Radio.
Hi, nice to meet you. I think this is the first time we're speaking.
Absolutely. So it is the first time we're speaking. And I've been doing this since the 07 crash off and on in my life. And it's always nice to bring diverse opinions onto the air and introduce them to the team. Tell everybody a quick synopsis about yourself, and we'll start going into the markets and everything else.
So really quickly, I've been following the markets since the mid '90s. I was early teens when I started. We worked on Wall Street for a really long time in various roles. The last role was a buy side trader, both equities and both international and domestic equities. I was trading during the 07, 08, 09 timeframe, have lots of fond memories of that. And then about 10 years ago, I went off and started work on my own. And I discovered I had a voice in writing, so I've kind of just been running with that.
Fantastic, sir. So let's get your opinion in a broad stroke of this past quarter, which is about to end with the window dressing period on Monday and Tuesday. What do you make of everything we've seen, not just from a market perspective, but also from a commodity market and treasury market perspective? It has been one of the more unusual Q3s as far as what I think is a bubble, but others may have an opinion. Please, sir.
It's certainly been interesting. I don't know that I could find the right word to characterize it. You have gold and commodity prices, like you said, going higher. You have cryptocurrencies actually going lower. And you have the equity market, which has been sort of in this strange rotation. It feels like I've been telling people, it feels like when you go to the circus and the clowns are trying to spin the plates on all their different hands and their chins and everything, and they're just trying to keep them spinning and not to fall down. And that's kind of like how it feels like every day in the stock market. Um, yeah, it's been a really strange period of time. I mean, on one hand, one side of the crowd thinks we're heading into a recession, the labor market's going to fall off a cliff. And the other side of the cloud talks about they're running it hot. I don't know who they are, but they're running it hot and we have fiscal dominance. And I don't even think they know what fiscal dominance means, to be quite honest. But I honestly, the biggest problem is that the data is so bad. The quality of the data has been so bad and so unreliable. One minute we're in a recession, the next minute I can't make heads or tails of anything. And I think the equity market generally is just ignoring all the news and just keeps on going with Nvidia. I don't know how else to explain it, unfortunately.
I cannot disagree with you at all, sir. And I also would like to follow up on that. You were talking about the market data, and I think that led into what I think was another blown call by Powell and company. The PCE has components which are extracted from the BLS data, and
Yeah.
we just heard the president rip the BLS to shred, fire the head, and say the data is not good. Do you not find it unusual that we're willing to promote the inflation data coming from the same department as good, but the employment data is garbage?
Yeah, well, not only that, but a lot of the data in the CPI, I think, is like imputed. It's not real actual data because I think some of the data they don't have enough people to go out and get all of it. So yeah, I mean, it's the same agency, so I don't see how some of the data is good and some of the data is bad. I mean, I mean, gold is supposed to be an inflation hedge, right? I mean, gold is certainly sending us a different message about inflation than what the numbers are telling us. And it's kind of funny because you hear like some of these guys talking about how when the rates are restrictive, and I mean, financial conditions are loose as they've been, and since when the Fed had negative was doing 120 billion a month in QE and had rates at zero. So I don't know what makes them think that by cutting rates, if you can't get rates down to 2% after 5 years of having, raising policy and keeping it restrictive, apparent supposedly, that what makes you think that cutting rates is going to get it down to 2%? I mean, the whole thing is just totally screwed up, and I it- I literally, I try to watch as little news and I try to read as little news commentary as I possibly can. I just try to just stick to the facts because otherwise I feel like I'm going to throw up half the time.
I understand the feeling. I listen to a lot of podcasts and broadcasts about the markets, and I also watch the mainstream financial media only because I like to hear their opinion or what the latest push and pump is, so to speak. And you never hear the phrase fiscal dominance, but everyone is promoting it. I saw your discussion with Grok. If you want to summarize what that looked like real quick for our audience, and if you haven't looked at it, folks, go to Michael's X account and read this. It is amazing
About physical dominance.
about fiscal dominance. Yeah, I was like, oh my God.
Well, I do that. The new thing I discovered is, the great thing about AI is you can have like you kind of lead it down the road you want it to go down. And I obviously know what physical dominance, what the true definition is, but I don't think a lot of people on Twitter do, or whatever it's called now. So it's like I know how it's going to answer, and so I just lead it with the questions. And it's funny because the true definition of physical dominance is like when you're running like this emerging market economy, and you're trying to issue all this debt, and basically the central bank is just doing whatever it needs to do to sort of accommodate the needs of the government, and less so worrying about the inflation targets and things of that nature. And it's like we couldn't be further from physical dominance, like if our lives really depended on it. Like, we don't have a central bank that's trying to support the US government spending plans. We don't have a central bank that's certainly not, buying US debt at this point. We certainly don't have a central bank that's, you know, conducting policy to make it more appealing for the US to continue to issue cheap debt. I mean, so it's the furthest thing from the truth. And and so like I'm just kind of tired of reading about this running hot, and physical dominance stuff, because it's just I don't think that there's a real understanding of what it actually is, because it almost feels like when you're talking about physical, what you're basically implying is that the US is going Turkish, or it's going down the road of Argentina, which is having a crisis right now. I don't think we're anywhere close to anything like that. People don't realize that the US is the reserve currency of the world. And the way that we operate, that puts us in a distinct advantage, because we can issue debt because our dollar, everything is valued against our dollar. So it gives us the advantage of being able to issue debt however we like, and not really having to worry about it as much as, let's say, a country that has to value their currency versus the dollar. And as far as I know, there's very few options out there where you're going to get rid of the dollar as a reserve status. I know that the yuan is supposed to be up and coming, but I'm sorry, like, that's not exactly a stable government that you'd want to be trusting to have as your reserve currency of the world. I mean, I get there are some players that may be willing to go along with it, but I don't really see that playing out worldwide. And so I think people don't they forget about the fact that because we're the reserve currency of the world, everyone is valuing their currency and their valuations against the dollar. It's not us valuing it against them. And I think that's a big difference, if that makes any sense.
Actually, it does make perfect sense because there's still a sizable portion of international debt and transactions occurring in the dollar. And I'm not one of the milkshake people, believe me, by any stretch of the imagination. But I also see a new trend that's developed, and it's very interesting. We're at the precipice of going back to something from your original trading days, and back when I was closer to younger, the mid 90s, where gold holdings by the central banks will probably exceed U.S. Treasury holdings by the end of this year. Do you think that that is an indication of a loss of faith in the reserve currency, or the bifurcation of the trading system on a global scale where people are trying to just not be married to the dollar and the whims of Mr. Tariff?
So actually, I think the FT did an article on this a couple weeks ago, and I kind of get what they were saying. It's they were trying to basically say that it's a little misleading, right? To think that, that gold has really surpassed it. In nominal terms, yes, gold has gone up tremendously, and that's allowed it to increase in value. But at the same time, treasuries have fallen in price dramatically, making them worth less, at least at least in nominal terms at market value. And so I don't really know if that's a really good fair gauge, to really think about it in that terms. I don't. That would be that would be sort of my first thought. And I mean, in terms of whether or not people are losing faith in treasuries, it's hard to say. I mean, it certainly doesn't seem like it, based on the fact that you still have you know government debt being sold fairly easily. Treasury auctions have been going fairly well. If you look at some of the holders of our debt, I mean, that the international buyers are still there. I think if you really started to see treasury auctions not going well, I think if you really started to see the holdings of treasuries really begin to decline, I think that would be a better indicator than the actual market value. Because gold could fall 20% in 2 months, and then all of a sudden it's a different sort of look, I guess.
Yeah, but one of the things that I always sit there and look at the treasury market is I always look at the TIC report. And I know that
Yeah.
just makes me look boring as hell to the rest of the world, but it's something you have to take note of. And everybody always looks at China, but I always look at the Caribbean islands. And those are considered de facto hedge funds for the main New York City banks and other banks around the world. And we now have the Cayman Islands. And if you've never flown over the Cayman Islands, folks, you'll do it in 5 seconds in a jet airplane. Trust me. It's nothing, but they have 460 plus billion in treasuries on the books. And you have to wonder, are we using that to launder Or are we using that to store and just offset it so it doesn't overwhelm the books in New York? It bothers me because there were some great articles in the early 2000s about the Pirates of the Caribbean. Rob Kirby led this analysis, by the way. It might be before your time. I'm old, I admit it. Where hedge funds would buy from the primary dealers to keep the liquidity fund moving, and make it look strong, the books look stronger than they really are. I'm not saying the treasury market's on the verge of collapse. In fact, if anything, I'm predicting lower yields in the next 2 to 3 months. And I think that's going to be of a bigger shock. As I looked at the patterns, I'm biased. I think the 2007, not economically, but as far as the treasury behavior, is similar, where we're going to peak out the next several weeks, and then it's going to start stepping back down below 4%. What's your take on that, sir?
I mean, given the way the data's been going, anything is possible. I think also to your point, the what's really interesting is the UK has surpassed China in terms of treasury holdings. But I think it depends on what the data is, because at this point, the one thing that seems clear to me though is that the treasury yield curve seems too flat. And I think part of the reason why the Fed is cutting isn't so much to alleviate financial conditions and make policy less restrictive. I think it's more so because they have to, at this point, get the yield curve to steepen some. I mean, I think the spread between a 10 year and a 3 month is only like 20 basis points. So if you're an investor and you can choose, why would you buy a 10 year, take on 10 years worth of risk when you can get a 3 month for basically the same rate? So I think that is part of it. And I also I my view has been that, sort of the 10 year, I think, has a floor in it between 3.90 and 4%. And the reason why I'm saying that is because, again, because of the steepness of the curve. And, if you look at Fed fund futures, they've been pricing in about a 3% terminal rate in this rate cutting process by the end of 2026 now for some time. And if you just kind of think about what a normal curve looks like by the time you get done with the steepening of it, I mean, 10-year rates should probably be 250 to 300 basis points above a 3 month. And so if you kind of look at that, it kind of puts me in the 5 to 6% range overall, unless, of course, the Fed cuts more than 3% and they go to 2 or something. But that, I think, would be because of a recession. So I mean, if it's sort of looking like to you like the economy is really slowing, then yeah, I mean, rates, I think, would go down. But at this point, assuming everything stays neutral and we don't see a further deterioration in the economy, then I think that it'd be really challenging for 10-year rates to go down.
Yep, and I have to tell you, I come from a different standpoint. I am more of the logistics transportation analysis, along with precious metals. And as far as precious metals are concerned, I think they're sending more of a geopolitical warning than an inflation warning. Stagflation seems to be the path that we're choosing. And the reason I say that is I think the Fed will live with stagflation, but will not live with high inflation, too hot, too cold. They're going to try and get the porridge, quote unquote, just right for the three bears. And I think that's going to backfire on them. The transportation industry is showing every indication of a recession that's probably going to begin or has begun already in this coming quarter. And with the decline in length of haul, revenue per mile, et cetera, all the normal measurements, and the decline in imports on the horizon, as bookings from China seem to be in a declining state, it would seem to me that the Fed can't get ahead of the curve because of its commitment to trying to get the inflation rate down to 2%, but they will tolerate a higher inflation rate simply to maintain a minimal to slightly higher level of growth. Although right now they're projecting 8% on the Atlanta Fed, if I'm not mistaken.
That's right. But yeah, I mean, they're already tolerating higher inflation. They're cutting, right? So I mean, they're already telling us that to some extent. This whole cycle has been one of the screwiest cycles I can remember. And the other fact is, I mean, The only thing that I think at this point is holding up this economy from the standpoint of the reason why we're not in recession is this AI spending. And because everything that you kind of look at tells you that we should really kind of be in one, but we're not. And the only conclusion that I've come to is that it seems like, AI has the data center spending and the GPU spending is sort of keeping everything afloat and making things look probably a little bit better than maybe what they are. And my guess would be is if you started to see those capex rates come down from some of these companies, that you would see the economy slow pretty materially. Um, but it seems like I don't know, these numbers keep getting bigger and bigger. I'm not really sure where they're getting all the money from. uh, Maybe they have a printing press or something. But OpenAI is working on how to create money out of ChatGTP or something with their 3D printers. But I don't know, like, I don't know how they make commitments when they don't even have access to the capital. So I don't know what any of it means anymore. It just sounds like numbers are getting thrown around. So it's impossible to some degree to predict whether we're going to be in a recession or not. I mean, I think stagflation, we're probably already there throughout most of the economy. And I think, like I said, you have AI, which kind of makes things look a little bit better than what they are.
And that's the thing. I think you see this high level of capital spending, but it's very reminiscent. And I have family members that were involved in the great uh, .com bust who, uh, lucky for them, made a large amount of money. It seems very 99-ish, 2001-ish, but at the same time, the irresponsibility of the government, the spending, the central bank behavior is also familiar to the '07 period and to a degree the '87 period. I'm not calling for an '87 crash yet, boys and girls, but it does seem very irresponsible at all levels. And the backfire is what I think should scare some people and start hedging, if you see what I'm saying.
Well, I mean, when you look at the market overall, it's extremely overvalued. I look today and we're trading at 25 times 2025 earnings. Growth is only around 11.5 or 12%, which isn't really great for a multiple that high. I know people will say, well, the makeup of the S&P 500 is better than what it used to be, but the makeup of the S&P 500 is also reflected in the earnings. So, in theory, the earnings growth rate should be better than what it is, if you want to go by that logic. And the market today has very it's very I think people, it feels like it's 2000 in a lot of ways, but it feels a lot worse in some ways because the market today, I don't know if you remember. I mean, I remember the 90s as really, that was a great time to be an investor. I mean, I was going to school. I was 96 to 2000. I was going to college. So I remember making phone calls from my cell phone in between classes to make trades with my broker, and all the things that I was doing to try to pay for college with doing it. And it was a lot of fun. I mean, the other side of it wasn't very fun. But I feel like today there's a lot more concentration risk than there was then. A lot of people talk about the big tech names that led the charge and the unprofitable tech stocks that were in the market. And people forget that the S&P 500, the top 10 stocks were names like Microsoft, Cisco, Intel, but then you had GE, you had Exxon. I mean, go look at a chart of GE, and the stock got as high as it did, and it never, I don't know if it ever really ever got back there, because now it kind of split up into three separate companies, but the stock stayed below those 2000 highs all the way through to, like, the COVID. So, GE was the furthest thing you could be from .com, right? Everything was going crazy. I remember Sovereign Bank, which isn't around anymore, but Sovereign Bank came public, and they didn't come public, but they put sovereignbank.com, and the stock went up 20 or 30% in one day. I mean, that was what was going on. Walmart came out, they're going to go .com, stocks would go crazy. You don't really have that today. But what you do have is these really strange moves with these stocks that are moving, a $4.5 trillion market cap. Stocks are moving hundreds of billions of dollars in market caps in a day, as if it's just like water is just sloshing around in a bathtub. I mean, that's scary stuff when you think about it from that perspective. So I think the market today is just it's a lot worse because it moves much faster. I think it's much more concentrated than it ever was. And the size of the 3 or 4 stocks that are in the index, when you think about it, Nvidia is 4.5 trillion, Microsoft is 3, Apple is in maybe Microsoft is 4 now. I lose track, and Apple's in the 3. So you have 2 companies, 3 companies, and you add Google in at 3 and Amazon at, if you take the first 5 stocks in the in the S&P, they probably have market caps of about 2/3 of US GDP. I mean, that's crazy.
And it's dangerous because a lot of the valuations are based on the buybacks of the stock instead of reinvestment and growth. Would you not agree?
Well, yeah, there was a chart today I saw somewhere on X that showed that Alphabet got its share count down to the same level it was at in 2007
Oh, those
because
were good times.
because it's been buying back all this stock over the years. So
And yeah, it's insane because you can't sit there and just keep buying stock back to keep the valuations high for quote unquote bonuses for certain individuals and think that that is representative of real value. I mean, at some point you have to make things and sell them, right?
I mean, I've owned Alphabet for my own portfolio for a really long time, and look, they have put up really good numbers. A lot of quarters where you were kind of like, where'd they get that from? But they're also running. It looks like if you look through their financial statements really closely, that other income is like running a hedge fund for them. They have where they had like $100 billion just in this other account thing, and so I mean, there's a lot of things going on some of these balance sheets and income statements that kind of miss the point, like what you're saying, and so I tend to think that over time you have to always be able to innovate. You have to keep those margins up. Otherwise, why are what are you investing in? And so, yeah, I mean, to some degree, buying back stock works. It helps to increase your earnings. It makes them look better, but it's not really creating real shareholder value.
110% agree. And I remember, I don't know if you remember the 2007, 2008 fiasco where everything had .blockchain or blockchain added to the name. What was that T company? Do you remember off
Oh,
the top of your head?
2017.
Yeah,
Yeah,
2007.
2017,
Yeah,
17,
we had,
18.
yeah, everything was add blockchain to their
Yeah,
name.
Long Island iced tea turned it. I remember. I
That's
mean, I
right.
live on Long Island, so I remember that one.
It
They
was
be
insane.
Yeah, yeah. Well, that
And
was
so,
when Square changed its name to Block. Was that when
mhm.
they changed their name to Block? And then we had the Metaverse when Facebook changed its name to Meta. But yeah, I mean that's like it's always like something that's always an interesting thing to see. Like it kind of, when companies get wrapped up in the theme of the day and go and change their names and change their corporate identities to kind of fit in with what the general theme is, which always kind of is a warning to me. It tells me like, oh, they're doing this because they're trying to distract everyone from something else going on at the company that's really probably not all that positive.
Tend to agree. And right now we're in the middle of this AI thing. I have no idea what they're thinking. It looks great on paper, makes for some snappy commercials, and will get you 2 minutes on one of the financial networks, but it doesn't provide any value to the stock. I'm going to leave you with a thought real quick because I want you to sit there and promote your writings, your Substack, and yourself on X. Free plugs. We do it for all our guests. Please take a minute and do that, sir.
So I am a writer I write on for Seeking Alpha. I usually put up 1 or 2 pieces a week, sometimes 3. I publish under mottcapitalmanagement.com. I also run a subscription service on there called Reading the Markets. I have a Substack as well called Navigating the Market. There I provide a free daily commentary. I also run a subscription service there as well. But again, if you want to just get the free commentary, I usually put out like a it's not totally in depth, but it's usually a 300 or 400 word sort of end of day commentary, just talking about what's going on in the marketplace, some interesting things I observed. I have a YouTube channel where I put out a YouTube once or twice a week. And I'm here on X posting, random things throughout the day under Michael Mott CM. Uh, I don't know, a few times a day, I try to come on and just post some random thought or post some random chart that I find interesting or some piece of data. Or sometimes I like to have fun, like I had tonight, and play with Grok and throw some topics out there.
Absolutely. We appreciate you coming on with us tonight to sit there and talk about this, because also don't forget macroedge.net, macroedge.net. Go there, subscribe for the 2-week free trial. New, larger things are happening there. Follow the MacroEdge team, learn about the real estate and other insights. Folks, we're going to grow. We're going to sit there and provide information like Michael, with speakers like Michael, who give you facts, perspective, and alternative ideas, not the usual run of the mill. Hey, look at what we're promoting. We want to bring the information level down to numbers, not down to pumping individual stocks and garbage. Real quick, sir, as we get back into this, the number one traded stock on the NASDAQ was 181 million shares for a 52-cent stock called Dragonfly Energy Holdings with a market cap of $17 million. Does this Robin Hoodie retail mentality play into that article you wrote on Sunday about the market setup has rarely been this treacherous? I find that aspect of it pretty damn dangerous. And I'd like your take on that, sir.
Well, I mean, you can see the speculative nature all over the marketplace. I don't know that it needs to be a penny stock. I mean, Oracle was up 40% in one day, not that long ago. I mean, I called it peak stupidity, because that's what it was. I mean, it went up some ridiculous value in market cap on this letter of intent that was from like the three usual suspects, the three horsemen of Nvidia, Meta, and OpenAI, the biggest spenders. Yeah, I mean, you can see it in stocks all over. Oklo, it was up like 30% in one day last week. It's all over the place, and it makes me nervous when you start seeing stuff like that. I mean, in the meantime, the rest of the market is kind of just hanging on, trying to get day by day. And it's funny to watch like how they kind of grind the index higher. It's like the earlier this week it was like this theme of S&P up, RSP down. RSP is the equal weight S&P 500 ETF. S&P up, RSP down. RSP up, S&P down. S&P up, RSP down. And then it was like you had to find the stock that was lifting everything. One day it was Apple, the next day it was Tesla. And meanwhile, you had and then on the days when the S&P was down, you had to find the stock that was down. One day it was Amazon, another day it was Nvidia. I mean, it's just like the whole thing is just like jury rigged at this point to kind of like keep everything going. And in the meantime, you have this sideshow going on in some of these really weird stocks, that I've never heard of before, but have these obscene market caps. Um, y- you know, I don't. This is the type of market where it was like I remember when I was a kid, we sit around the lunch table and try to come up with stock ideas, and usually it was like we would just pick the most volatile, craziest things out there because that's where you can make the money. And it seems like it's the same sort of frenzy, speculative mentality. And the truth of the matter is the gamification of it. I think I was seeing something the other day, and in South Korea, they had these video and these like big room set up where people were like watching their favorite crypto trader. I've never seen, I guess I could say I've never seen stuff like this before, but I also lived through the time where the day trader was invented. And so, at the time that was also viewed as fairly crazy. And it was very speculative and all the other stuff. So, I mean, it comes around, it just comes around with more modern technology. So it's just a sign of the time, I think.
Do you think that there's a misunderstanding or misallocation of risk comprehension by this younger generation of traders. I think retail believes that because it's on their phone, because they can take margin out on a credit card, the government or someone will always be there to bail them out. And every time we've run into this in our history in the last 40 years, and I go back to being in high school in the 80s, and I was just telling someone earlier, uh, first time I made money in any kind of market was I had physical silver and sold it in 1980, bought a car and wrecked it. You understand how that works.
Yeah.
It was high school. But
Yeah.
you sit there and look at the big picture. People don't understand the risks that occur playing options, zero DT options, etc. And I think usually Mr. Market has a way of teaching a lesson. That's pretty scary when you take the grizzled vets. I'm sure you would consider yourself one now too, considering the length of trading time you've been trading. It's got to put a little bit of concern in your mind that there's too much of the gamification and gambling aspect of it versus actual investing and creating value.
Well, you forgot about zero DTE. I
Yeah,
mean,
exactly.
I mean, that's the biggest casino of them all. It's the access to not only, you know, leverage, but it's the leverage on leverage. You know, when you go and you buy options on margin, right? I mean, you're levering up a lot, and it's the gamification. It's, I also think we live in a cashless society where there is no physical money to hold anymore. It's the same thing. I mean, I have kids that are 14 and 11. They have no concept of what money is. It's just, they send me a thing every day. I'm getting requests from my 11-year-old for Robux. It's like $20, I'm like, where do you think I'm getting all this $20 from? Every day. It's like, no, you're not getting any more. It's the same, my one daughter, I got her like a kid debit card just because I didn't have cash always. So, I mean, she runs around town, Apple paying everything. The money's gone in an instant. And so I don't think it's just a market thing. I think it's become a cultural thing, and it's probably because of the digitalization of money. And so it doesn't, I mean, it's a number, it doesn't really have a value. It's just a number. It's $100. What is $100? Well, I mean, it's just 100. So I think there's part of that. And then of course, the market investors, if you came into the market after 2010, your whole career you've been taught that you don't need to worry about it. The Fed will bail you out. The market always goes up. And, I thought the same thing too. In 2001, market only goes up. Look at the chart. Since 1982, all it's done is gone up. Look at the chart since 1900, it's only gone up. But you realize that there's long periods of time that are in between where it doesn't go up. But what you also realize, which is the most important thing that everyone misses, is that yes, the market can always go up, but that doesn't mean the stock that you own will. And that's the biggest thing that I think everyone forgets. Yes, I mean, the market will always go up over time, but the market is an active index that's constantly changing on the S&P 500. Trust me, if you bought Cisco in 2000 or 1999, the market didn't go up for you. You're still waiting to get back to that all-time high, which I don't think we've eclipsed yet. It's the same thing for Intel, and it took Qualcomm 20 years to get back to that high. So I think people don't realize that, when you're buying a stock, you need to understand what the chances are of this thing continuing to go up. And so when you look at a thing, and that's why we have valuations. Um, and so, like if I look at Nvidia today, people would say, well, why don't you own Nvidia? Well, my personal view is that Nvidia is in a space that can be commoditized. I really can't tell the difference right now between all the different AI models. I use a bunch of them. They all seem basically the same to me, which tells me that at some point prices on these things will just start coming down. Companies like Microsoft and Apple and Amazon, and they're buying these GPUs, and every year NVIDIA comes out with a new GPU, which means the GPU they've already invested in is going to be depreciated at a faster rate. I think we're just, I think it's a, s- it's a sign of the times. I think that, people are not they're thinking about the market, they're not thinking about the stock. And to be honest, like, I don't know if anyone actually buys and holds anything anymore today. I think it's more about gambling and zero DTE, and not really having a concept of really what money is.
I think you just made me feel older, Michael.
I'm
But
sorry.
it's okay. There are some juniors that I'm still holding on to and watching carefully on the technicals. I have to admit that up front. Well,
Yeah.
I want to ask some questions going back to the value of money, because there's two issues that I see with politics intersecting with the economics. And we talked about this and touched on it. Do you think there's a gray/black swan out there in next year primarily, although it could happen this year, depending on the Supreme Court, of the Federal Reserve being Nixonized, where Burns was imposed on the market? Granted, he was a good economist, but he only did the bidding of Nixon as far as monetary policy was concerned. And where a lot of people don't understand this because they're not from that era, Volcker was prodding Nixon in the background to make these things happen. Do you think there's a risk of the Fed becoming politicized to the point where it looks, from a market perspective globally, that it is a tool of the administration versus an independent central bank?
Well, I mean, Trump's already told you he's going to pick a low rate guy. So, I mean, he's already told you he's going to put someone in there that's going to cut rates to where he thinks they should be, or around. So, I think that that's already out there. I mean, he's obviously trying to reshape the Fed in his image. And I mean, I don't know any problem. I voted for Trump, but I don't necessarily agree with everything he's doing. But uh, you know, I think that he's trying to recreate a Fed in his image, more of a lower rates type of Fed. And I think that he's already made that abundantly clear. What I don't understand is, why haven't rates gone higher? And they really should be going higher, especially when you think about that risk. And so, yeah, I think there's a very good possibility that, when May comes around and he picks, his next Fed lieutenant, who's going to be, maybe Kevin Warsh, maybe Chris Waller. I don't really know who it's going to end up being, but I think he's made it abundantly clear that it's going to be someone that's going to represent the things that he wants. And even, I think everyone forgets, but during his first term, he made a mistake with Jerome Powell. He was very unhappy with him for quite a while. And uh, uh, so I think that he already has done it. It just hasn't been put into motion yet. And I think there could be that kind of scenario where you see rates kind of blow out. But actually, if you want to know which one, where I'm actually more concerned, I'm more concerned about what's happening in the UK, and I'm more concerned of what's happening in Japan than I am really here. I don't know. I can't hear anything.
Let's try this again.
Oh, there we go.
Yeah, somebody, a spammer, just somehow overwhelmed my do not disturb and tried to call in during the show. You have to love this with modern technology.
Oh,
Japan, I think, made a strategic and tactical mistake by not raising rates when they had the opportunity to over the summer. And now, with the political discourse in Japan, if they raise rates, it's going to seem pretty doggone desperate and maybe ignored by the markets as too little too late. Is the yen carry trade possibly something to analyze for future exploitation in the year ahead? I think we could easily see a move back towards 160 unless they take a serious policy change and course of action, probably in the next 60 days.
yeah. I read your piece just before we came on. I wanted to see what you had been thinking about. And the thing that I thought was really interesting, again, I happen to agree with you. I think the BOJ has clearly made a policy error, which is something they're known to do from time to time. Um, and I mean, they have had plenty of opportunities to raise rates, but they're so afraid of making a mistake that they're actually making a mistake by not raising rates. And at this recent one, they had two dissents on, which is very unusual, that they wanted to raise. And I think that probably means that we're going to get a hike maybe in October. Um, I don't know what it means for the carry trade because, in theory, with rates going, I mean, the yen has very much been tied to the interest rate differentials between the US and Japanese rates. It's, if you do the US 10-year minus the Japanese 10-year, or the US 5-year minus the Japanese 10-year, and then you overlay it with the USD JPY, it's basically the same chart up until recently. Now they've started to diverge. And I was convinced that the yen carry trade was going to implode on itself if the BOJ hiked at that last meeting, because that spread was just collapsing. Um, and now it seems like you're saying the yen carry trade seems to be getting a second life here, because if you've noticed, the spread has actually been still sort of down, and it hasn't really gone down anymore, but it hasn't rebounded. But yet the yen keeps weakening, and I find that interesting because that's kind of telling me two things, right? It's telling me that either the currency market doesn't believe the BOJ is actually going to go through with rate hikes, or it's telling me that rates in the US are too low and it believes that spread is going to re-widen again and you're going to see the yen weaken. So I'm not sure which one is the right answer yet, but in both cases, it's kind of the FX market is giving you this fake sort of signal, a signal of the market doesn't believe somebody. And so I think if the BOJ actually raised, I think that would really lead to the opposite happening, with the yen really strengthening materially if they came across hawkish enough.
I agree with you. I think they would have to sit there and somehow find a way to justify a 75 basis point increase between now and December. And I just don't see the political will in the Bank of Japan to execute that drastic of a move. Historically, they're very conservative, maybe 25, maybe 50, but I just don't see a big move that would reinstill faith into the yen, allowing it to strengthen. Love to hear your
Right. And
take on
I
that.
and I don't think they would go that big. It would probably be 25 in October, and maybe they would signal for another one in like January or March or something like that. I think that's about as much as hawkish as they would get. But the bigger issue too is what's happening there politically, because you just had another change in leadership, or you're going to have another change at the PM, which I find amusing that they signed this trade deal with the US right before the PM resigned. But anyway, so you have that going on, and they're talking about potentially spending more, or potentially talking about increasing deficits. So all these, sort of pro-inflationary type of things that really should get the BOJ more concerned and potentially raising rates. Um, because I fear that they could lose control of the long end of the curve. I mean, some of these auctions on the 20, 30, 40-year auctions have not been going well. And I'm concerned about that. And I'm also really concerned about what's happening in the UK, because it seems like, just last week, I think their budget came in $18 billion deficit versus 12, which is a minute number compared to what we're dealing with. But rates blew out there, like, over, and the pound collapsed in that one or two sessions. And if you look at a chart of the pound, I'm sorry, if you look at a chart of the gilts, I mean, those rates look like they could explode in a much more meaningful way. And we're talking about two of the largest economies in the world, in the UK and Japan. And I know that they're minuscule in the terms of the US sense, but I mean, they're still. I mean, look. I mean, Nvidia and Microsoft and Apple are bigger than the two of them combined, which just gives you the ridiculousness of their valuations. So, I mean, but I still fear for what it could mean, because I think that U.S. investors forget that if rates go up around the world, rates in the U.S. are going to go up too, and I don't see how that's not going to happen. If you see rates in Japan starting to rise and you see rates going up in the UK, that's going to have an effect on rates here. It's going to destabilize a lot of different, pricing mechanisms. It's going to strengthen the dollar materially. And so if you want to talk about, your black swan, it would be sort of BOJ, BOE, kind of like, some sort of sovereign debt thing, like similar to what we had in 2011, but instead this time being the UK and Japan.
I'm not going to dispute that, because I think the thing that the outlier on this, and this is where the politicization of the Fed comes into play, is the risk of, and we're hearing the term, but we're not going to see it, folks. I'm just going to tell you right now, it will happen in the dark. You just won't notice it until the rates stay there, of yield curve control in the United States becoming a policy of devaluation of our currency. And it'll become a race of devaluation versus a race to stabilize bond markets. And I think that's the policy risk we have with the current administration. Now, look, I didn't vote for either political party. I voted for DeSantis, up front, outside, for everybody, because I was disgusted. I wanted a real conservative. But when you look at the big picture of this, if you have the politicization of the Fed and the Besant influence of wishing to suppress yields to a point to stimulate growth, they'll eat a little inflation, in my opinion. But like you said, the global destabilizing factor is something I don't think the administration is taking into account.
No, and what are they going to be able to do? That's really the bigger, that's the bigger issue. And I mean, I hope we don't go down the road of yield curve control. I think that would be really detrimental, and would really be disruptive to the whole economy. Um, but I would think that, right now, the way things are kind of going, um, y- I'm kind of in the mode where I just don't understand why rates on the long end of the curve are so low. I think the market in some ways still thinks we're going back to rates of zero with QE. And I can't really blame them for thinking that, because that's all we've known since 2010. But in reality, I think it's pretty clear that we don't need to have those type of rates, and QE. And I think, yield curve control would be a major mistake, because I think the bond market hasn't really traded free. This is the first time the bond market's traded freely in 15 years. You've had no price discovery for 15 years. And so, now is really the first time that you're getting some sense of price discovery. And you can see what's happening in Japan, and you can see what's happening in in England, and even in Germany. I mean, the spread between an Italian 10-year and a German 10-year is like 80 basis points. We're talking about, you haven't seen a spread that tight since like the 1990s. It's amazing to me. You want to talk about why spreads are so tight? Look at that, and that's going to be your basis for why spreads are so tight all over the world, because there's this political shift that's happening all over the world. In Germany, they're looking to spend more. You have different parties coming into power. If you look at a BTP in Italy versus a French oat, those spreads have collapsed. I think the Italian rate was actually lower than what the French rate was at this point. The spreads have inverted. uh, I mean, so you have all these different crazy things going on around the world where, we're spending, and all this debt and all of this, easy money is now really coming home to roost in some ways. And so I think that you could have a similar type of outcome here if you continue down this road of yield curve control, which is basically what QE is at the end of the day. It's just not without it. It just doesn't have the targeted rate. So I would think that right now, I think what we're really seeing is the effects and the aftermath of all the spending that's been done, not just before the COVID, not just during COVID, but before it as well. And so now all this money has to find a new home and has to settle down. And I think we're going to be living in a world that just has higher rates. We did in COVID what we should have been doing in 2008 and 2009 with the spending, but we just didn't do. And that's why it also took so long, I think, for us to come out of that recession.
Well, I'm going to throw a really wild stat at you because I love this kind of geek stuff from the days of the pigs. Right now, the U.S. 10-year note has a 115 basis point higher rate than Cyprus's
Oh,
10-year
Cyprus.
note.
Oh.
Now,
I thought you were going to
guys,
say Greece.
Greece is in the 60s. So that should tell you how crazy things are right now, where
Right.
people are actually piling money into the garbage, weak sisters of Europe, which believe that economic growth is socialism. And here we are with a higher rate. So that brings me to the big questions. One of the listeners asked a great question. Will the bond vigilantes ride again?
I don't think there's enough of them. I mean, where are they? I think that was like a term that was around what in the 80s. They don't seem to exist. I don't see them. And if they're there, then they're not really having a material impact. The treasury market today is controlled by the basis trade. I mean, which seems like, you could just move, too much the wrong way and the whole thing could blow up. Um, the everything is systematic. So I think that the problem is that today we live in a different market than what we lived in 20, 30, 40 years ago. Today you have a lot more trend chasers, a lot more momentum players, and I don't think that they exist anymore. I think the bond vigilantes would have to be like Japan and the UK. And that's not exactly, the ones that we would want to have as our bond vigilantes, because they have their own problems. But I just don't see them. And I don't know. I wish there were bond vigilantes, but they don't seem to exist.
So what you're basically saying is the bond vigilantes are like the fraternity in Revenge of the Nerds, where they're beating up on the weak sisters and trying to avoid the big guy in the big fight, which would be the U.S. Treasury.
Right.
Because let's face reality, you don't want to try and take on the Fed or the Treasury if you're a vigilante now, because they've proven they'll curb stomp you out of existence really quick.
Oh, sure. I mean, if rates started to go up, if rates started to really go up out of control, the Fed would step in and stop it. Or the Treasury would do something to try to control it. They would just start issuing bills again. It would just stop all issuance on the long end of the curve completely, probably. Because it just seems like, I think also to some degree you've just had policymakers, although they don't always do the smartest things, they seem to just be more on top of what's happening, and they don't seem to be as in the dark. At least what I'm noticing over the last 9 months. Um, and it seems like they're, trade talks are going well. They're always going well. They never go poorly. So I just feel like they're playing into the market and trying to say whatever they can say to soothe it. And so that makes it really challenging for anyone to have too much confidence on one side or the other.
Well, I don't want to abuse our time together. I always like to end the show with some big questions. So let me hit my big question, because this is the meat of the discussion. You've provided a great insight for our audience about what's been happening, your opinions on the market. And again, folks, I started following him on Simply Alpha. Seeking Alpha. You should follow that website, seekingalpha.com. Look for Mott Capital Management and join it. It's worth your time. It's worth that additional 10 minutes per week to get additional insights besides my own, and of course macroedge.net. So let's go to the big question. We're at quarter end, and in my opinion, we're exiting the eye of the hurricane and heading into the real storm as people are trying to reset for 2026. And there's a very high probability the IEEPA tariffs are going to get tossed, on the pure fact that there is nowhere in the law itself that says anything about fines, penalties, taxes, or other expenditures that purchasers must make from overseas. It was designed to go after foreign banks primarily. With this level of instability and the potential of higher oil prices, higher commodity prices, and steady to slightly lower bond prices, what do you see as the fourth quarter play or risk that people should start paying attention to and be aware of?
Um, I don't know if I want to say it, but I
Oh,
think,
please do. That's what we're here for.
yeah, I mean, this reminds me a lot of 2018 again. I think, but I think the pain trade I've been trying to tell my readers is, higher rates, stronger dollar, and risk off equities and risk assets. Um, I don't really know. I've tried to talk to some of my friends who are attorneys, and some of them, know more about constitutional law than the others. But a few of them have noted that they feel that the Supreme Court, even though these tariffs may be illegal, they feel that the Supreme Court's going to find a way to at least allow the president to keep them in place because they don't want to take away too much of his power and ability. That's what they've been telling me. So they know better than I do. But forgetting about that, when you look at where realized volatility is, it's extremely low. I mean, the S&P 500 today was up 55 basis points, and realized volatility went up on 9 and 1 month volatility. 3 month volatility is at levels not seen since January of 2020, uh, September of 2018, December of 2007, and then you got to go all the way back to the summer of 2014 to find lower 3 month realized volatility. So realized volatility is about as compressed as you can get it. Um, that means that implied volatility is probably not going any lower, maybe going higher. On top of that, we know that liquidity is getting sucked out of this market with all this treasury issuance going on. Um, and the market is extremely overvalued, lots of speculative behavior out there. Technically, it's extremely overbought. Um, the breadth indicators look horrible. Uh, and the question really comes down to is what are these companies going to say on their October earnings reports when they report in October? Are they going to have rosy outlooks with huge capex spending plans again, or are we going to hear that they're paring back some? And really, more interestingly, I'm kind of curious to see how they're going to start depreciating some of these big purchases they've made over the last number of quarters, and seeing how that's going to start potentially impacting their earnings going forward. So I think from a standpoint of where we are right now, the market looks extremely treacherous to me. I I am not I am not bullish on this market one bit at this point. I mean, yes, we could still go higher. I mean, the bubble case is 25 times 12-month forward earnings, which puts you around somewhere around 7,200. But I mean, do you really want to play for another couple hundred points? At this point, I don't know. It depends on what your perspective is. But I, I think that this feels, it reminds me a lot of 2018. The setup is very similar to where we were in the fall of 2018. And and to some degree, it also reminds me a little bit of where we were in the late 90s going into the 2000 turn. Um, there's just that same sort of feel with the way they're doing this. I don't know if it's really round tripping, but it feels like round tripping. Nvidia is going to invest in CoreWeave so CoreWeave can buy Nvidia chips. Nvidia is going to invest in OpenAI so OpenAI can buy and can lease Nvidia chips. You know, OpenAI is going to give $300 billion to Oracle so that Oracle can buy $300 billion worth of Nvidia chips. I mean, it's like the biggest circular reference I've ever seen, and I don't understand. If you notice the other day, Oracle actually went down when they announced they were going to do an $18 billion debt offering. if you pay attention to when Meta reports results, see how much cash they burned this quarter to spend on their AI crap, because they're running low on cash, at least cash on hand. And they're going to have to tap the debt markets again probably too. So, it's interesting because these big mega cap names that are supposedly, these cash flow cows, it would be interesting to see how big their cash flows are at the end of these quarters, and whether or not they're going to have to go to the debt markets to keep financing this AI investment, and whether the market's really going to be okay with that, because that kind of takes away some of their luster around these companies that have given them those superior valuations. Um, I don't know. So I probably said too much.
Actually, I think you said a lot, because your last statement really highlights my reason for lower rates. Between housing in a full-on implosion due to valuations and affordability, and major corporations are probably going to have to tap the debt market, there is an incentive to suppress yields, at least for the next 2 quarters, in my opinion. And that's the dangerous part of this. You never know how the rest of the world is going to react. And the last thing we need is a currency war. Mike, please promote your website, promote your writings one more time for our audience. Gang, if you're not following him on X, please do so. Go ahead, sir.
Thanks. So here on X, I'm Michael Mott CM. On Seeking Alpha, I publish under Mott Capital Management. On Substack, it's called Navigating the Market. And I publish, free stuff on Substack, Navigating the Market, every day. And on Seeking Alpha, I publish probably 2 or 3 days a week some longer thought pieces. The point of them is not always to be right, but sometimes it's also to kind of point out, the things that no one's talking about. And I think that, I care a lot about making sure that all the information's getting out there. And so I try to do my part with that. And I wanted to say congratulations to you guys as well. I saw you were launching a new institutional product, so I was really happy to see that you're continuing to grow as well.
Well, thank you, sir. And thank you for joining us tonight. Don't be a stranger. We would love to talk to you again, because we have a wide variety of guests, as you've heard, and we enjoy market perspectives. It's nice to talk nothing but markets with a little bit of macro, and really drill down into some of the insanity we've seen. And by the way, 2018, I will promise you that most people forgot what happened in December of 2018. One of the biggest Federal Reserve interventions in history. And I think people need to pay attention to that, don't you?
Yeah, that was a pretty interesting time. And I just wanted to say, I've seen you like my stuff in the past. I've seen you leave comments. I don't respond to everyone on Twitter. So it's really been a pleasure to get to actually meet you and talk to you today. And I'll be following you a lot more often now.
Thank you, sir. And thank you for joining us on MacroEdge Radio. Everyone, macroedge.net/ozone, macroedge.net/ozone, 2-week free trial. You can read my stuff. You can read the contributors to our website. Also, you can find out more at macroedge.net about all of the great ventures we have in the future. Please check us out. Next Friday night, I may or may not be here. That is up to the boss. Yes, I have a boss, and I listen to everything she says. So I'll keep everybody informed on X. In the meantime, for MacroEdge Radio, this is John Galt speaking. Good night now.